What is depreciation? Depreciation is the systematic allocation of the cost of a fixed asset over its useful life. It is a non-cash expense that recognizes the usage and aging of assets such as buildings, machinery, vehicles, and equipment. 2. Why depreciate assets? To match expense recognition with revenue generation, matching principle. To reflect a realistic value of assets on the balance sheet. To comply with accounting standards and tax regulations. To assist management in planning for asset replacement. 3. Assets. Subject to depreciation property, plant, and equipment, PP&E, that have a limited useful life. Land is not depreciated because it generally appreciates over time. Factors affecting depreciation. Cost of the asset. Purchase price plus any cost to prepare the asset for use. Useful life. Estimated time. The asset is expected to be productive. Residual, salvage value. Estimated value of the asset at the end of its useful life. Method of depreciation determines how the expense is allocated over time. Methods of depreciation. 1. Straight line method. Equal amount of depreciation expense each year. Formula. Depreciation expense. Cost residual value. Useful life and text. Depreciation expense. Frac text. Cost. Text. Residual value. Text. Useful life. Simple and commonly used. 2. Declining balance method. Accelerated depreciation method. More expense recognized in early years. Formula. Depreciation expense equals book value at beginning of year times. Depreciation rate on times. A text depreciation rate. Common variant. Double declining balance. DDB. 3rd. Units of production method. Depreciation based on actual usage or output. Formula. Depreciation. Expense. Cost residual value total. Estimated units. Used in period text. Depreciation. Expense. Frac. Text. Cost. Text. Residual value. Text. Total estimated units. Times text. Units used in period. Suitable for assets whose wear depends on usage. Depreciation expense is recorded each period. Debit depreciation expense. Credit accumulated depreciation. Contra asset account. Impact of depreciation on financial statements. Reduces reported net income through expense recognition. Lowers the book value of assets on the balance sheet. Affects cash flow indirectly. Non-cash expense. Important for tax calculations. Depreciation expense may be deductible. Asset management best practices. Maintain an up-to-date fixed asset register with purchase date, cost, useful life, and accumulated depreciation. Regularly review asset useful lives and residual values for adjustments. Perform physical asset verification annually. Record asset disposals accurately, recognizing gains or losses. Use software tools for tracking and depreciation calculation. Practical example. A company purchases machinery for 1 million naira with an estimated useful life of 5 years and a residual value of 50,000 naira. Straight line depreciation. 1 million naira minus 50,000 naira equals 190,000 naira per year. 50,000 naira divided by 5 equals 190,000 naira per year. Journal entry each year. Debit depreciation expense, 190,000 naira. Credit accumulated, depreciation 190,000 naira. Summary depreciation reflects the allocation of asset costs over time and plays a crucial role in financial reporting and asset management. Understanding different methods helps businesses choose the approach that best fits their operational reality and reporting requirements.